So one of the questions that I get from my clients is, should they pay off a mortgage or not? And here's a video from Dave Ramsey trying to deal with that question. And I find sometimes listening to Dave is he's got some great ideas and thought processes, but sometimes we differ a little bit in how we look at things. So here's a little bit about what's going on with Dave.
Hey, I'm doing well. How are you?
Better than I deserve. What's up?
Hey, got a question regarding the mortgage. I know you guys talk about, I have no debt, and I know you talk about putting 15% towards investments and then the rest going towards your mortgage. My wife and I are incredibly risk tolerant. Lost about $50,000 in our mutual funds over the past month, and still just sold my car, invested that money straight into the stock market because they're on sale. So I think that the math says investments. You're obviously a very successful man, so I'm not going to argue with you, but I'd like to genuinely know why do you go with that approach versus the investments if you're risk tolerant?
Well, risk tolerance has to do with what your emotions will.
Which the first thing I want to focus on here is he's going to start talking about risk tolerance, which the person calling is relatively young. And he's already talking about risk tolerance in his own vein. So I don't necessarily want to focus on what Dave's idea of risk tolerance is. My bigger question is, what is the young man's idea of risk tolerance? Because they're two different things. I mean, we already know Dave's been doing this for a long time, and he has his own risk tolerance, but it may not be the same thing as the person who's calling. So we're already jumping to a conclusion here that we're going to focus on Dave's risk tolerance, not his. Now, I understand he's asking Dave's opinion, and I get it. When I'm dealing with a client who wants to know whether they should pay the mortgage off, what I need to find out is what is their risk tolerance and what do they consider risk tolerance and where are they wanting to go with their future.
Will allow you to do without going into freak out mode.
Sure.
Okay. And so someone who has a very low risk tolerance can become a poor investor based on the fact that their low risk tolerance causes them to not take enough risk. Agreed?
Mm-hmm. Yep.
Someone who has too high a risk tolerance can cause them to be a poor investor because they take risky investments that end up losing more than they make because they live out on the edge.
Should say, yeah, I'm 99% mutual funds. I'm 1% in football helmets. So I'm in. I mean,
for the score.
Football helmet
I like
for
it.
this gentleman.
Oh, this is so great. A new measure of
but
things.
It's fun to listen
awesome.
to hear everybody having
Born
fun
on
with
the
this
air
comment.
today. I love it. That's Pat Jackson. Jackson, you get the award. You could go do whatever you want after that. So, no, I'm kidding. All right. So, yeah, but my point is, okay, so I grew up in the real estate business, and one of the things you do in the real estate business is they take your risk meter and they break it with a hammer. Real estate people have complete risk tolerance. We're idiots.
Uh-huh.
We're idiots. We don't even know there's risk.
Okay, now I want to stop it here. Now, a lot of my clients are real estate investors, including myself. And when it comes to real estate, I'll agree with his comment here that we are risk takers and that our risk meter has been thrown out the window. But that's because that's what we're doing for a living. And at least on that part of my business, what I'm focusing on is literally real estate. So it's a different world than investing in the stock market, investing in real estate. So he's right. You do throw it out there. But honestly, some of my most conservative clients, when it comes to risk tolerance and in actual investing in real or a stock market, are my real estate investors, because in their mind, they're so far off the reservation, so to speak, as far as their risk tolerance, because of being in real estate and having leveraged and things that they're doing. They want their investments on stocks, bonds, mutual funds, and things of that nature to be more conservative than they are on the other side. So I don't know that I necessarily agree with what he's saying here, because just because you're high risk tolerant in one area of your life doesn't mean you're high risk tolerance in everywhere. Now, again, that's a broad statement too, because there are some people that I know that are very risk tolerant in real estate and very risk tolerant in investments, but it doesn't necessarily always pull true. So keep that in mind here.
Okay, and that's what caused me to go broke, because I was not measuring risk. So here's what ends up happening. Debt equals risk. More debt equals more risk. Less debt equals less risk.
Sure.
It adds risk to the portfolio. You're saying I can emotionally tolerate that. That's one discussion. Another discussion, though, is what is the fastest route to wealth, regardless of risk tolerance.
Now, my next question here, and this is something that in general, I don't necessarily agree with Mr. Ramsey on these regard. What is your definition of wealth? And as my wife continues to tell me and has been telling me for many, many years, the new wealth is actually time. So if all we're talking about is asset value or net worth, that's one thing. But wealth to me means more than just what's my bottom line and what's my assets versus liabilities. So I don't know that I necessarily agree with what he's saying. He's saying the fastest way to this. And I don't know that the fastest way is always the best way either. Because again, it all depends on your personal situation. So again, I know he's broad stroking this, but it is one person here who has kind of laid out a relatively specific plan that, they're already putting 15% of their assets into 401ks and retirement plans, and they seem to have a plan for their mortgage. So I don't know what the desperation is to pay off mortgages that quickly. I've always had the rule of thumb, and I'm not big on debt. I agree with Dave on that, but I also say keep short-term debt short. If you have a car loan that's at 1% and you're paying it off in 3 years, I know he says pay all those things off, but keep it down, pay that. And am I going to pay that off quick? Sure, but am I going to put a bigger time frame on paying that car loan off than paying off a mortgage that I've got at 2.5% that's going to be paid off in 15 years? And when I'm balancing that with the ability to put some money aside so my wife and I can take a trip to, St. Martin, or my wife and I can take a trip to Vegas, or I can actually enjoy my life and have wealth in my life and the way I'm living my life, rather than just paying off debt and all I'm doing is working and paying off debt, paying off debt. There needs to be, in my opinion, a better balance than that, especially if you think you've got things going in the right direction.
What's the fastest route to wealth? And within that, then, okay, we've got to discuss, can I stomach that with my risk tolerance? Do I have enough risk tolerance to go that route? The fastest, surest route to wealth, not just, and most likely. So I would go back to something like the 10,167 millionaires we studied. And the number of them that said, because I had a high risk tolerance, I kept a mortgage the whole time and I invested all the money. And today I have $1 million in mutual funds, or I have $2 million in mutual funds, and I owe $600,000 on my house. The number of them that said that was less than 10%.
Okay, now this is the one I really have a difficult time with, and I'm not belittling this question. I know many, many real estate investors. I know many, many millionaires, multimillionaires. And when he sits down and says that less than 10% of them currently have a mortgage and have mutual funds and have this balance, I will agree with him. What I'm thinking he's misrepresenting here, and I not say thinking, and again, I'd have to look at his study a little better, but what I think is happening is that they didn't do this over a course of time. Most business people put together a business plan, and if you can put things down, and let's say it's a 10-year or 15-year mortgage on something, and have a plan to have it paid off, and still be able to balance that by enjoying life a little bit, by taking vacations and spending time with your kids and having a quality of life, I think that's a bigger issue. And I think if you actually looked into and spoke with and talked, dug down deeper with these 10,000 millionaires that he interviewed, they would tell you it was a much bigger, broader spectrum than just saying, we took everything else we had, we paid off all of our mortgages and dealt with it. And I'm guessing it was probably more of a situation where they paid off their house and not necessarily their investment houses. rental properties and so forth, because there's other reasons for having those. And again, I don't want to broad stroke this and I don't want to go into the weeds, but most real estate investors that I know that have had properties for a long period of time, sometimes there's tax advantages for having mortgages, for having debt, for being able to refinance it, pull money out without having to pay taxes on it. Again, there's more to it than just that. And I understand there's a risk factor in there that he's talking about, but I think he's dumbing this down too far. It's not just as simple. When I'm talking to my typical client who's coming in, who's not a real estate investor, who isn't a multimillionaire, who isn't one of the 10,000 people, for the most part, I'm going to set them up on a plan to have that house paid off. My goal is always to make sure that the house is paid off by the time they retire. If they're 35 years old and they've got a mortgage and it's going to be paid off by the time they retire, I'd rather actually set aside a budget for them to actually go and enjoy their life and take vacations, and because we're not given tomorrow. We don't know that. We don't know if we're going to be here. So I'd rather have them enjoy life and have fun with what's going on, spend some time, and again, diversify life and spread that out a little bit. So I don't know that I agree with what he's saying here, and I think it's an oversimplification of how these millionaires made it. And again, to me, it's not about speed. It's about doing what's best for the client.
90+% said, I got my house paid off and I dumped everything in mutual funds in my 401ks. Okay, so the practical facts are the normative way, the most likely way, the highest probability way, according to the data, to build wealth is to invest into mutual funds and to get the house instead of, because otherwise you would say, all right, I'm going to borrow as much as I can borrow on the house all the time, and every so often I'm going to refinance it and throw all of that money with a cash out and stay mortgaged up to my eyeballs.
And again, no one is saying you have to be black or white. There can be a mixture here. So again, I don't necessarily agree with where he's going or the total advice that he's giving. And it might be that this person's got too much risk. I mean, I don't know. I'd have to talk to them more about it, which is why in this particular case, I wouldn't be explaining to this gentleman the way I'm explaining it. I think it is far too broad stroke for this particular investor.
Yeah.
If the concept worked, you would do that. But the problem with that is that it affects other things in the unseen, and that is that the borrower is slave to the lender. You make different decisions in your life.
Okay, and I'm going to stop it from there because then he starts getting into some weeds. He starts talking about beta and having different mutual funds, this, that, and the other. And again, not my part of this particular conversation. This conversation, what I want for my clients to realize or understand is that paying off a mortgage is a good thing. How you pay off that mortgage can be a different thing. And it all depends on where you're at and your scope of things. I mean, if you're 60 years old and you're trying to retire next year, again, paying off the mortgage is going to be a bigger question. If you're 35 years old and you were able to lock in last year at a 2.5% or 2% 15-year fixed rate mortgage, again, I'm not going to be as concerned about paying that off because 15 years from now you're going to be 50 years old. I mean, is it going to really help to pay that mortgage off faster than 15 years? Probably not, especially when you have the ability to invest part of that money each particular month and enjoy part of that money by going on vacations and spreading it around and diversifying not just your wealth, but your time. And again, to me, your overall wealth and your well-being. So to me, that's the way I would look at it. Talk to a financial advisor, put together a financial plan that works for you and your situation. Dickie out.